Most people think a country dumps a metal for one reason: desperation, a budget hole, a collapsing currency, a fire sale. So when China suddenly pushed more than 660 tons of silver into global markets, the easy story wrote itself. Beijing panicked, prices would crash, and the rest of the world would scoop up the bargain. But here's the part that doesn't fit. The market wasn't calm. It was tight, twitchy, and already showing signs of stress in physical supply. In a market like that, flooding silver isn't just selling, it's moving the single lever that decides whether a squeeze explodes or quietly disappears. And when you watch what happened next, the panic sale theory starts to look like a cover story. Because after that shockwave shipment, the tone changed. Policies tightened. Export channels narrowed. The gates started to close, which raises the real question: why release silver at the moment it mattered most, then reverse course and lock the system down? If this wasn't desperation, what was it? A warning, a test, or a calculated reset of who controls the price? And if Beijing can flip that switch once, it can do it again. Only next time, we may not get a heads up. Number 1. The silent buildup before the silver shock. For most of 2025, the global silver market looked tense but manageable. Prices were climbing steadily, but analysts brushed it off as another round of green transition. Inflation. Solar manufacturers were scrambling to secure raw materials, while investors began quietly hoarding coins and bars as inflation hedges. Beneath that calm surface, however, warehouses from London to Shanghai were draining faster than expected. Physical deliveries lagged, and refiners started paying premiums just to keep supply. Chains alive. What nobody realized then was that China had quietly become the balancing force, holding the key to easing or amplifying the world MS silver shortage. Inside Beijing's policy circles, silver wasn't viewed as an investment story. It was a strategic commodity, fuel for solar panels, electronics, and energy storage technologies, driving China's global manufacturing dominance. Throughout early 2025, the government had tightened export data disclosures on several critical materials, framing it as environmental policy. Yet insiders saw a deeper motive: control. By tracking and restricting the flow of industrial metals, China could decide when to flood markets and when to starve them. That same philosophy had already reshaped rare earths and graphite exports. Silver was next in line, and it was becoming clear that any sudden change from Beijing could trigger an international chain reaction. Then came October 2025. Without warning, customs data revealed that China had exported an unprecedented 660 tons of silver in 1 month, enough to jolt every major trading hub. Analysts scrambled for explanations. Was this a desperate move to cool prices or a calculated test of global reaction? Within weeks, London inventories steadied, borrowing rates dropped, and panic faded. Yet the victory was hollow. Chinese warehouse stocks had fallen to their lowest point in a decade, and whispers emerged of new export restrictions for 2026. What appeared to be an act of relief had, in truth, set the stage for a new kind of control, one where Beijing could decide the tempo of the world's silver supply with a single policy shift. This was not panic, it was preparation. Number 2, when markets mistook control for chaos. When China's export data hit the wire, markets reacted instantly. Silver prices whipsawed as traders tried to decode whether this was a genuine liquidation or a strategic maneuver. Western analysts initially called it a fire sale, assuming Chinese producers were offloading excess stock to avoid future losses. But the timing made little sense. Global prices were near record highs, and demand from the green energy sector was booming. Why would a government that guards its strategic resources suddenly unleash more than 660 tons into circulation? The deeper answer lay not in panic, but in precision. Beijing understood that markets were nearing a breaking point. By releasing just enough metal to cool panic, it avoided a total liquidity collapse while keeping itself at the center of the silver narrative. Behind closed doors, this was a masterclass in influence. China didn't just move metal, it moved psychology. The surge of exports restored confidence in paper silver markets and calmed investor sentiment, allowing Beijing to quietly achieve 2 goals at once: reassert control over pricing mechanisms and stabilize volatility that threatened its own industrial margins. The West viewed it as a sell-off, but Chinese policymakers saw it as calibration. They weren't losing control of the market. They were demonstrating that they could create balance on demand. Every ton of silver leaving Chinese ports was a reminder that the world's dependence on Beijing wasn't financial, it was physical. And yet, the calm didn't last. Within weeks, traders noticed Chinese inventories were falling to critical lows, and whispers emerged that the government was preparing a second act: new export licensing, stricter oversight, and potential quotas for 2026. The same move that brought relief to London and New York had drained domestic supply. it became clear that the dump was temporary, a deliberate test of how far China could push before prices or politics snapped back. When the reversal came, it confirmed what few had suspected. Beijing wasn't reacting to the market. It was rehearsing control over it. What looked like chaos was actually choreography, and by the time the rest of the world understood, the rules had already changed. Number 3, the unraveling behind the curtain. By early November 2025, analysts began to notice something unsettling. China's silver inventories were vanishing. Warehouse data from Shanghai and Shenzhen revealed stockpiles falling to levels unseen in nearly a decade. And what was once thought to be a harmless export wave now looked more like a strategic drawdown. Factories that depended on silver for photovoltaic production quietly raised procurement bids, and state-run firms were instructed to prioritize domestic stability over foreign shipments. The same 660-ton flood that calmed Western markets had effectively drained China's own reserves. This marked a transition from relief to restraint, and Beijing's next step would confirm it: export control. By December, China's Ministry of Commerce began drafting new export licensing rules for strategic materials, including silver, following a model already tested with rare earth elements. The stated reason was environmental sustainability and supply chain security, but insiders knew the timing was anything but accidental. After watching how the world reacted to the October export surge, China realized it now possessed a new kind of leverage. Every bar of silver crossing its border could now carry political weight. The global market, especially solar manufacturers in Europe and America, had just learned a hard truth. Their clean energy ambitions still depended on Chinese policy. The message was subtle but clear. Price stability would now require cooperation. International reactions came swiftly. The United States hinted at reviewing strategic metal reserves. European refiners lobbied for clearer supply commitments, fearing another squeeze. Meanwhile, speculators, emboldened by the October surge, found themselves wrong-footed as Beijing began restricting exports again. Prices swung wildly, and a new phase of volatility took hold. The narrative shifted overnight. China wasn't just a participant in the silver market. It was its architect. The 660-ton dump was never an accident. It was a test run for influence. By playing both savior and supplier, Beijing demonstrated how to cool a panic and weaponize relief at the same time. For the first time, traders began to realize that the question wasn't whether China would move the silver market again. It was when and for whose benefit. Number 4, the global shockwave that followed. By January 2026, the ripple effects of China's silver maneuver began surfacing in unexpected places. Manufacturers in Germany, Japan, and South Korea, who relied heavily on imported silver for electronics and photovoltaic cells, reported supply delays that stretched weeks longer than usual. Futures contracts became harder to hedge, and premiums for immediate delivery spiked. Western economies, already struggling with inflation and currency volatility, found themselves facing a new dilemma. Silver, once seen as abundant, was becoming a geopolitical asset. Every export license Beijing issued or withheld carried implications for clean energy projects and industrial output across continents. The October flood now looked less like a market event and more like a diplomatic rehearsal in economic influence. Financial markets tried to respond, but their solutions only deepened uncertainty. Traders flooded into paper silver, ETFs, and derivatives to bet on volatility, but the disconnect between physical and paper supply widened. When actual metal became scarce, paper contracts could no longer mask the shortage. Meanwhile, alternative producers in Mexico and Peru struggled to ramp output quickly enough to offset the shortfall. The mining industry's structural weakness became obvious. Most silver isn't mined directly, but is a byproduct of other metals, meaning production couldn't just surge with price spikes. Every metric screamed vulnerability, and investors started realizing how much of the global system rested on China AS decisions made months earlier. Governments scrambled to react. The European Union proposed a new strategic metals reserve, modeled loosely on oil stockpiles to prevent future supply disruptions. The United States quietly reviewed its dormant Defense Production Act clauses for critical minerals. Even India announced temporary import restrictions to stabilize domestic markets. Yet none of these measures addressed the core problem. China still sat at the crossroads of the world's silver trade. The same country that had exported 660 tons in one historic month could, at any moment, tighten its rules again and send shockwaves through every major economy. The realization hit policymakers like a cold wave. The silver market was no longer governed by pure economics. It was now a tool of strategy, and China had just demonstrated how to use it without firing a single shot. Number 5, the economic chess game beneath the metal. By mid-2026, economists began connecting dots that had been ignored for months. The 660-ton silver export was no longer being discussed as an isolated trade event. It was now seen as the opening move in a much broader economic strategy. China had quietly used a commodity to expose the fragility of Western supply chains, all while strengthening its internal command over energy and technology sectors. Every major policy response from Washington, Brussels, and Tokyo seemed defensive, not proactive. Beijing's maneuver proved that global markets were still structured around assumptions from a bygone era, where supply chains were diversified and metals were merely trade goods. That illusion had just evaporated. Inside China, the narrative shifted from trade to sovereignty. State-backed think tanks began framing metals like silver as strategic accelerants, essential for national security and self-reliance. The October 2025 export surge had achieved its secondary goal. It gathered intelligence on global vulnerabilities. Officials now understood how Western markets would react, how long it would take before stockpiles tightened, and how much pressure was required to move futures prices. What appeared as chaos from the outside was a meticulously studied experiment. By the time foreign analysts realized what had happened, Beijing was already adjusting domestic production quotas and negotiating bilateral trade deals to consolidate its grip on essential metals. Meanwhile, global investors were left chasing clarity. Silver prices swung violently, alternating between optimism and panic, while industrial users faced contract uncertainty. For ordinary investors, this volatility translated into confusion. Was silver a safe haven or a weapon? The answer depended on who controlled it. What began as a question of price had become a question of power. China had turned silver into a diplomatic instrument, capable of influencing inflation, technology production, and investor confidence all at once. The world finally understood that the 660-ton shipment was not the climax of the story. It was the beginning of an era where every ounce of silver carried strategic consequence, and every decision from Beijing could rewrite the rules of global finance. Number 6. The pattern that never ends. By late 2026, the silver market had settled into a strange rhythm, one that seemed to echo past crises in oil, rare earths, and semiconductors. Every few months, a headline out of Beijing could send prices swinging. One report about a new export review could spike futures by 10% overnight, while the shipment of refined bars could drop them just as quickly. The volatility wasn't accidental, it was structural. The same pattern kept repeating: shortage, surge, restriction, and relief. It became clear that China wasn't just responding to market pressure, it was creating it when useful. The October 2025 dump had revealed a formula for control: dominate the physical flow, influence sentiment, then tighten again once the market stabilizes. What looked like chaos was a system, one that placed China permanently at the center of industrial metal strategy. For Western economies, this was more than an inconvenience. It was a vulnerability. Silver's role in clean energy technologies meant that price spikes translated directly into higher costs for solar panels, batteries, and electric grids. Each market tremor delayed production timelines and complicated national energy targets. The United States began exploring partnerships with Latin American miners, while the European Union poured money into recycling initiatives to recover silver from old electronics. But scaling these efforts required time, years, not months. Meanwhile, every short-term solution looped back to the same bottleneck: China. By controlling not only production, but also the timing of exports, Beijing could modulate pressure points across multiple industries simultaneously. Financial institutions adapted by pricing in permanent uncertainty. Hedge funds started calling silver a geopolitical metal, and investors treated it like a weather system rather than a commodity. Unpredictable, but inevitable. Some even speculated that China's broader goal wasn't profit, but discipline, teaching the world to depend on its supply chain timing. That realization changed the tone in global trade discussions. Suddenly, every conversation about clean energy and digital infrastructure included the same quiets. Warning: control over materials is control over progress. The 660-ton release was never a mistake. It was the rehearsal for an era defined by managed scarcity. The world had thought it was watching a market correction. In truth, it had just witnessed a demonstration of power. What the 660-ton move really taught the world. So when people call this a 660-ton silver dump, it sounds like a mistake. Like Beijing tripped, dropped the metal, and the market simply reacted. But the timeline tells a colder story. China released a historic volume at the exact moment the global system was under stress, when physical silver mattered more than paper promises. That single wave eased pressure where it needed to, reshaped sentiment, and bought time. Then, once the panic cooled and the world relaxed, the rules tightened again. Licensing, oversight, and a narrower gate. The point wasn't just price. The point was proving that a strategic commodity can be used like a dial. Turn it up to stabilize, turn it down to regain leverage. And here, I'll ask why that matters now. Silver is no longer a niche trade for collectors and hedge funds. It's welded into the future: solar deployment, electronics, data infrastructure, electrification. When demand is structural and supply is slow to expand, the market becomes policy sensitive. That means the next major silver move may not come from a mine or a refinery. It may come from a government memo, an export approval, or a quiet restriction that hits supply chains before traders even understand what changed. 3 takeaways. Physical supply beats paper narratives. When real metal gets tight, headlines and charts don't matter. Deliverable bars do. Strategic metals are becoming strategic tools. Countries don't manage these markets like normal commodities anymore. They manage them like leverage. Volatility is the new baseline. If scarcity is managed and releases are selective, price stability becomes temporary by design. If one country can calm a squeeze and then tighten control right after, the question isn't, will this happen again? The question is, what happens when the next squeeze hits during a global crisis, when everyone needs silver at the same time? If you want part 2, comment silver and tell me what you want next. Or 1, China's strategy explained. 2, how this affects solar and tech prices. Or 3, what it means for investors. And if you're tracking these hidden shifts in global power, subscribe, because the next market shock usually starts where nobody is looking.